Good morning, everyone. Good afternoon to some of you. And this is David Barry from the Leading California World. And we're doing Money Matters, episode 19 this morning. And because it does. And Terry, I want to clarify right off the bat, I'm not a fair-weathered fan. I've been a fan of these guys since when they were in LA. But we did have a win that we probably weren't supposed to get over the weekend. I don't know how much of our members watch football, but at any rate, good morning, gentlemen. How are you, Terry?
I'm great, David. Yeah, the Oakland Raiders are doing great so far.
No. Las Vegas Raiders. I'm from Las Vegas.
When did that happen?
Good morning, Monty.
Morning. Great to be here.
Hey, I have something I wanted to unveil today for you guys and our members, and I think you guys are probably going to be asking me for this for Christmas. Hold on one second. Let's get this.
Oh, very nice.
Wow.
Very nice, David.
Yeah, we and to any of our members out there, if you use any of our realtors or if you use our national lender, we're going to figure out a way to get you one of those. So anyway, let's get started. And this is the week we've been waiting for. It's crazy. It's finally here. I believe this week we have some news coming from the Fed. What's going on, Monty? Let's get the rundown.
Yeah, we do, for sure. The next 2 days of meetings ending on Wednesday, the 18th, will show the Fed cutting rates. We've been waiting for this for a long time. So a lot of anticipation around what we're going to hear on Wednesday, whether it's a 25 basis point rate cut or a 50 basis point rate cut. The thing I did want to explain, though, right from the jump here is when we know that these are coming, the market starts to price in these drops to some level, same as when Apple says that there's a new iPhone coming. The stock rises that day, the day of the announcement, leading up to the iPhone coming out. It's not like nothing happens until the day the iPhone comes out and then stock prices skyrocket. That doesn't really work that way. In the same way in mortgage interest rates, what they're cutting is the Fed funds rate, and that does correlate to the mortgage interest rate, but it's not the same thing. And when they announced this a couple months ago and started talking about September 18th is the day we're going to cut rates, then some of the impact, some of the positive rates dropping already happened. As we've seen over the past month to 6 weeks, we've seen a gradual dropping of rates. Even last week, we saw some good data, and that's what we're going to break down for everybody today.
Monty, it's awesome that you bring that up because I know that a lot of my clients and a lot of your clients, they get information from their friends or from their cousin. And when you have a professional that can actually break it down and explain it to you like that, because most people think, well, I got to wait till the rates come down. And what you're basically saying is, no, don't wait till the rates come down. But when the announcement is made 4 or 6 months prior to, and you start seeing that dip, and you don't have to watch like we do. But when you have someone on your team that's a professional like us, and you have access to that education, you can get the real facts. What do you think about that, Terry? I mean, this is exciting, though. I got to be honest.
Sure. And I believe, and Monty can confirm this, I think mortgage rates have been getting better for some time now. And so, Monty, the way I would explain it, and maybe you can confirm or clarify, the Fed, they're just doing what everyone else is doing. They're seeing what's happening to the economy. So the same people that determine mortgage rates are also seeing that, and that's why rates are getting better. The economy's slowing down, unemployment is going up, and so therefore they can cut rates to help juice the economy a little bit. We just want to make sure that they don't juice it too much by going half a point or something like that. But it's more the Fed is more of an influence than they are determining, right? But some people think the Fed determines interest rates on mortgage. That's not right. So can you just clarify why the Fed is maybe an influence, but not the determining factor in mortgage rates?
Yeah, for sure. When COVID happened and we were dealing with interest rates that went to nothing, literally zero, they changed the Fed funds rate to zero. And people thought that meant interest rates were going to be zero, mortgage interest rates. Well, that doesn't work that way. They correlate, but they're not the same thing. And so what we may see this week is depending on what Jerome Powell says, the interest rates could go up slightly. And the reason that could be, let me go back to my Apple example. The day that iPhone comes out, if there's bugs, if people are complaining, if there's negative reviews, then the stock price for Apple could actually go down that day, not up on the day that the phone actually comes out. Doesn't mean long term that it's going to go down. It means that they've got a few kinks. It didn't go the way that people were hoping. And so if that happens this week, then we may see rates tick up just for a little bit. But the thing that we know is rates are going down. The Fed is turning the ship around. This is the beginning of the end. We have some data to break down like we always do so that it's not just our opinion. To David's point, the encouraging thing is when people jump on now, they're going to get the benefit. And we're going to talk about home appreciation as we go throughout today. They're going to get the benefit of that too, because there's two things. We got interest rates, but we also have appreciation. And so it feels like we get to be Steve Jobs today, and we're getting to say, hey, there's a new product coming, never before announced, or at least not for many years. And so over the next year to 2 years, we're going to see some really great things happen with interest rates. Here's your chance. Invest early in this company, and you will be very happy later. You'll be thanking us 2 years from now that you jumped in and did this.
Monty, thank you so much for bringing that up because you've been talking about this for several weeks. And I know that a lot of my clients and a lot of people, just people in general, are laser focused on the term interest rates. But when you tie appreciation to interest rates, that's the home run there for them. And can you dive into the into the appreciation element of this? Because I just want to remind all of our members and people that are listening, it's not just about interest rates, but explain what you mean by appreciation.
Great question. It's not the one that gets asked most of the time. It's hard for home buyers to ask, what do we think this home is going to be worth in a year, 5 years, whatever? We have a tool that will do that. We showed it a few weeks ago. So if you missed that episode, go back, look at that. I'm happy to customize it. But in the past week, what we got was the CoreLogic Home Price Index. And that showed us that home prices nationwide were essentially flat in July after really strong growth seen from March to June. So we saw some really aggressive appreciation in homes, and then July was just kind of flat. It happens. It's the summer months. People are taking vacation. Prices were also about 4.3% higher when compared to July of last year. So we know that we're 4.3% higher than we were even last year. So that's really positive, knowing that rates have continued to tick up. CoreLogic, that same group that released that report, they forecast that home prices would rise about 0.2% in August and then 2.2% in the year going forward. Their forecasts tend to be pretty conservative, though, so that's going to put us around 6.5%. We think it's going to be closer to 8% for the year. Last year was 6.5% over the year once we got the true data at the end of the year. So the bottom line of this is while home prices are slowing down, the gains are slowing down slightly. It looks like in the summer, they are expected to continue. And the latest Fannie Mae and Pulseonomics home price expectation survey, what that does is that takes 100 of the top experts across the nation for home prices and appreciation. And that showed that those 100 respondents, their average expectation of what homes would appreciate at over the next 5 years was 20%. So in the next 5 years, cumulative 20%, 4%, 4%, 4%, 4%, 4%, at least, probably more in major markets. So like Dallas, Texas, where I live, we expect that to be significantly more than 20% in the next 5 years. It could be 40% in the next 5 years. It really could, because so many companies are coming here. There's so much demand for these markets. So that's an average of the whole nation, 20%. So to quantify that, if you bought a $500,000 house, if you left California, let's say you left San Diego and you moved to Myrtle Beach, South Carolina, beautiful, beautiful area. We did it on the Freedom Tour, the Southern Freedom Tour. If you bought a $500,000 house there, that house should go up $100,000 in the next 5 years. So you just made $100,000 just because you left California and bought a great home. So that proves that this is still a great, great time. You haven't missed the boat. This is the announcement to get on the boat. Don't miss the boat. It's going to be a really exciting trip, and you're going to be a lot richer at the end of these 5 years.
Wow, that's a great breakdown. And it's interesting that we are blessed to have Terry Gilliam, and Terry Gilliam talks to people every day about leaving California, and he's an advisor. And the thing that I'm finding really interesting is, and I don't even remember what country, but somebody found you, Terry, from another country, and they want to do an interview of you as the expert of why people are leaving California. So not only are you giving advice every day to so many people and helping them get out of California because they want to, but who's coming in to do your interview?
Well, I was eating my breakfast last week and my phone rang, and I don't normally answer my phone, but it was a unique number. And I was like, well, all right, I'll answer it. It was the Swiss Broadcasting Network is actually coming to Central Florida this week. We're going to sit down and they want to know why people are leaving California. And I said, well, I've got some pretty good ideas, and they broadcast all over Europe. So I'm looking forward to letting the folks of Europe know why people are leaving California. And David, let me just add one thing to what Monty was saying. That national average of appreciation is for the nation. We know people are leaving California, they're leaving Oregon, they're leaving Washington, and where are they going? They're going to the South. So just because we're looking at a national appreciation of 20% over the next few years, I think the South's going to appreciate a whole lot more than that. We know the appreciation that's already happened in Texas, Tennessee, Florida, where I live. In fact, I was in Knoxville in 2020, touring homes with Haley Van Edom, my realtor there. We were looking at brand new construction at $350,000, brand new, 2,000 square feet, $350,000. That is long gone. Now that house today is probably closer to $500,000. So I want people to understand, if you're looking to leave California, Oregon, Washington, New York, and you're looking at these states that are having a lot of people move to them, appreciation is going to be significantly higher to probably. I don't have the perfect crystal ball, but I believe that that's going to continue. There's a reason people are moving here. It's because it's a lot more affordable. There still are places where you can buy affordable housing that is way less than where you're leaving, but also you live a much happier life. I am so much happier here in Florida than I was somewhere else, but appreciation is a real thing. Don't let a 0.25% of mortgage rates determine that you're going to move or not move. Look at what's happening with the appreciation in these homes.
Wow, Terry, I'm glad you brought that up because we're finding out that a lot of people are tuning into our channel and they're not even from California, but they know that we're giving out great information. So, and our tagline has always been, leaving California, welcome to America. But it doesn't matter where you're leaving. We want you to be welcome to America. And there's certain places, and Terry and I, and Monty as well, we go around the country and travel and find out what the best places are. And we just want to keep educating. Eventually, we may have to change that sign back there. But the reason we focus on California is because obviously there's more people leaving California than anywhere else in the country. So, but it's really cool to see that we're actually helping people from New York. We're helping people from all over the country with our information. What else you got for us today, Monty?
Yeah, well, I wanted to say on Terry's point there, it sounds like what Terry's trying to say is the South will rise again. The appreciation is going up in the South. So you heard it here first. The other thing I wanted to share with everybody is the inflation, what we're seeing, because that's the greatest catalyst for the Fed's decision this week on what they're doing. Unemployment does matter. We are seeing 1.8 million people across the nation still claiming unemployment. So that does make a big difference. But that inflation is what they're really looking at. And so last week we got the consumer price index, and that showed that the progress on the headline inflation rose about 2.5% for the 12 months ending in August. So every month we take the last month from 12 months ago, we take that out and we put in the current month's inflation data. And so that shows us on average where we are over that year. That marked, when we did this in August, that marked a slowing from July's 2.9% annual gain to the lowest reading since February of 2021. That core measure, what that does is that strips out the volatile food and energy prices, and that increased by about 0.3% from July. That came in a little bit above the estimates of what we thought that was going to be. The annual reading held at about 3.2%. And then the shelter and the motor vehicle insurance costs, those really have a big impact. Those are key reasons for the pricing pressure that was seen last month. Those together made up 89% of the inflation in August. So there's many other major items such as energy, new cars, used cars. Those things actually were flat in August. And what that suggests is that most of that inflation has really been quelled, except for a few key areas that are keeping it artificially high. What this means for everybody out there and what that means for the Fed is that this cooling consumer inflation and the rising unemployment, they've caused the Fed now to be where they can't deny it anymore. I think it was Terry at the start of the show said that the Fed is partly looking at where they need to influence but not dictate the mortgage interest rates. And that is true. But I would argue they are backward looking. They drive looking in the rearview mirror. They look at those 12 months over the past year to make their decision as to where they need to go. It's really a bad way to drive. None of us would do it. We would all crash if we drove looking in the rearview mirror to say, where have we been over the last 12 miles? That should tell me how fast I should keep driving on average. But that's what they do. And so that's causing them this week to finally change that Fed funds rate, which is not the mortgage interest rates again. That's the rate at which banks can borrow overnight. And so that benchmark Fed funds rate is what they're going to drop by 25 or 50 basis points on Wednesday. So we're waiting to hear that. That will be a good thing. Again, it's a beginning of the end. It's a signal that we are going the right direction. Goldman Sachs has forecasted 4 more rate cuts next year and 1 more rate cut this year. So if I was to tell you that a company like Apple was going to release 5 new products in the next 12 to 18 months, I think you would invest. I think you would jump in on that and you would say, well, I'm going to get in right now. I'm not going to wait till that 6th product has come out and then, then I'm going to invest. It's going to be great once they have 6 new products on the market. And yeah, I want to buy as much stock as I can. At that point, you kind of miss the boat. So don't miss the boat.
Monty, you haven't mentioned this in a couple of shows, and here's one of your passions. And
Yes.
I want to remind everybody, and especially all of our members, Monty always says that it's so important that you use professionals and you use people like us every time, as opposed to using your cousin or somebody that hasn't really sold a house, but they're licensed. And then I also want you to touch on how important is it for our listeners to stay tuned in to all of the things that are going to be happening over the next couple of weeks?
Yeah, it's very important to use a realtor that is extremely experienced, has been working over the past 2 years and doing a lot of business. That may seem unfair to say, what, so the people that are doing the most business, we should keep using them. Yes, you really should. Same way you wouldn't go to a doctor who is just getting started and saying they haven't performed any surgeries, but I want to help them too because I know them. You wouldn't do that. This is your money we're talking about. We need you to wake up and realize you've got to use a realtor who is the best of the best, who's trained by the best of the best, who is a phenomenal negotiator. Because then in that example before where you bought a $500,000 house in Myrtle Beach and you gained $100,000, you might gain more than $100,000 because they got that house for $475 because they were a great negotiator. Or they got you some sort of a buy down, so your interest rate was super low and you were able to put an extra $1,000 a month towards the mortgage. Who knows? But yes, thank you for bringing that up, David. We have to use realtors that we will tell you if you don't know. I can look up statistics on any realtor in the nation and tell you they've actually sold 50 homes or 100 homes in the last 2 years. That's a person that you can use. They know what they're talking about. We also have incentives within Leaving California. So we're even putting our money where our mouth is and helping you make that move. And then, David, you were saying things that we're going to be talking about over the next few weeks. You're wanting them to stay tuned to that?
Yes, definitely.
Yeah.
There's going to be a lot of stuff.
Gonna
And
be
I
a
mean,
lot.
what are we, less than 50 days? We're getting close to 50 days to the election. And Terry, you always talk about either side. We're still going to have this mass exodus leaving. And Terry, I know I want to be respectful of everybody's time. We appreciate you tuning in. Anything else you want to add, Terry, today to this show?
Yeah, we say it all the time, but if you're happy in California, please do stay. If you're not happy, it's always a good day to leave California. So if you don't pull the trigger this week, this year, we know things family-wise, work-wise, otherwise happen. But by all means, if you're considering even leaving in the next year, 2 years, 3 years, reach out to Monty. He can help you establish a game plan that will work for you financially so that when you sell your house, you know what you're going to do. Maybe it's buying an investment home in addition to a primary home. If rates are work in your favor and you can recoup that via rentals, it always helps to talk to somebody like Monty, especially Monty, because he's top 1% in the whole country. He is that specialist neurosurgeon that he was just referring to. He can really help you through this process. And what better way to go through with a plan than just trying to hope that it all works out?
Well, once again, we're episode 19, Money Matters. And because it does, we appreciate you tuning in. And please continue to like, subscribe, comment, share these videos with your friends. If you know of people that are leaving, Monty has an amazing team, and we keep bringing it up. But, don't believe me. Call and see for yourself. They're going to exceed your expectations for sure. If you're coming to Southern Nevada, definitely look me up. Terry, thank you so much for joining us today. I hope everybody has a great week, and we'll see you soon. Take care. Bye-bye.